Hi, Henrik. Thank you very much for joining us today. How are things in Copenhagen?
They are great here. Fantastic. The spring is here, so what's not to like?
I recently read that Copenhagen is the most bike-friendly city in Europe. It has a population of 600,000 people, but more than 700,000 bikes, and bikes actually outnumber cars 5 to 1. Are you a big cyclist?
Yeah, I am a big cyclist. I do road biking, so not so much for transportation, but which I think is what the most people do. But I like it for yeah to do sports to get around also and to go see the also areas outside of Copenhagen.
And I was recently in Amsterdam. That's another bike crazy city. I believe the population is around 800,000, and they actually have 1.4 million bikes, if you can believe that.
Oh, yeah. Okay. And most of them are in the bottom of the canals. We
Well,
have problems with that. That's I think there are a lot that gets stolen, unfortunately, also because you have so many bikes here. And so
no,
that's
it's
it.
funny you mentioned that about the canals because they actually have a city crew, and that's their full-time job is pulling bikes out of the canal. And I think they told us when we went on one of these tours of the canal, they said 8,000 bikes a year are thrown into the canals.
Yeah. Yeah. No, it's a lot. It's like I don't know if it's the same here, but probably.
So let's move on now. And I want to get your thoughts on the economy and the financial markets. And the last time we spoke was in early January, so 5 months ago, and a lot has happened since that time. And at that time, you thought you were quite bullish. You said we were in a Goldilocks economy. The GDP was strong, and it still is. Unemployment was very low. Inflation was approaching the 2% target rate. And you were expecting a massive rally in all risk assets, the S&P, the Nasdaq, Bitcoin, followed by a massive collapse in financial markets and all financial assets. And you said the resulting recession would be worse than anything we've seen since 1929. And the S&P at that time, when we last spoke in January, it was around 4,700. It's now around 5,300. So we're still about 15% away from your target. But where do you stand now? What's your take on the economy and also the financial markets? Hi, I hope you're enjoying the interview. One of the reasons we do these interviews is to help you understand what's happening in the global economy and also how to prepare for it. And during times of uncertainty and also never-ending inflation like we're going through right now, investing in physical gold is one way to protect your portfolio against inflation. If you would like to learn more about gold and how it can benefit your portfolio, visit hardassets.alliance.com. Hard Assets Alliance is a trusted platform that is used by over 100,000 institutional and retail investors. Once again, that's hardassetsalliance.com. There's a link below in the show notes. Now back to the interview.
So the economy right now, if you look at it right now, the economy is strong. And why is the economy strong? It's because we have the labor market. The labor market is strong. We saw the initial claims coming out yesterday, still very low. That number we need to see that move up, but we're seeing that the number of open positions are coming down, and especially if you take that in terms of how the number of unemployed. So we're starting to see some deterioration in the labor market, and we're also seeing more which was even more severe, the deterioration amongst the consumer, because the consumer right now is struggling with the high interest payments, and the interest payments is what every time kills the business cycle. So when you have an upturn, you have a bull market, you have an economy that is flourishing, it's always killed by the high interest rate which the consumer has to pay, and they will then pull back on consumption. And what you start to see now is the credit card delinquencies starting to come up, and they come up in a with a pace that we have only seen into the financial crisis. So it's actually kind of a two-headed tier here, that you can see that on the surface it looks good, and you see the stock market is up like what I've also predicted, but we're seeing the deterioration down below, and that is what is going to play out eventually.
So let's look at the economy a little bit deeper because once again, when you look at the economy, it looks very strong. Even though the Q1 GDP number came in a little bit weaker than expected, it came in at 1.6% versus expectations of 2.4%. So maybe we are seeing a bit of a slowdown here. It's going to be interesting to see what the Q2 number is like. But when you look at the jobless numbers, it's the same sort of thing. We've had 25 consecutive quarters of unemployment below 4%. And the last time we saw that was 1969. So the indicators are showing a very strong economy. And I know you just mentioned that you think the consumer is starting to feel some pain, but maybe you can give us a little more detail about what indicators you're looking at that leads you to believe that the economy is a lot weaker than we are led to believe it is.
Yeah, sure. So first of all, I have a methodology, a model that I use, and it's based on the conference board data, leading indicators, coincident indicators, lacking indicators. I have a model where, every time we've seen a recession signal coming from the leading indicators, we'll actually see that a recession sets in eventually. That has flashed. That flashed already early 23. And then people say, yeah, but then it's all over. And the conference board, by the way, have also, given up and said, now we're just continuing high, or that they don't expect a recession in 24 any longer. Well, I don't see it like that. I think that, as I've said before, I think Titanic has hit the iceberg. We still have the yield spread is still inverted. And I mean, it's interesting to see that people think, yeah, it's everything is fine, but the yields are, the 10-year is now still below the 2-year. I mean, that's interesting, right? And normally when we see the yield inversion, we have, a situation where that will deteriorate. And that is what I think we're seeing right now. We're just in that zone where where in Roadrunner, where you have the coyote running off the cliff, and then all of a sudden realizing that there's no ground beneath it, and then it starts to drop. And I think we're in that zone. It can last for some time, and I can understand, companies that have been building up capacities coming out of Corona with all the stimulus coming in, artificial stimulus, prices went up, and they actually did well. And a lot of companies were outperforming targets, and they said we have to build capacity. And when you did that back, just a year and a half ago, then you will probably be a little more reluctant to have to scale that down again. So you don't start to laying off people immediately when you don't get the demand. And if you look at the real sales numbers, they're not great. They're not awful yet, but they're not great. So if we just look at it, we're saying, yeah, well, are we going up from here, or are we going down? And I'm just saying the consumers right now and not right now, the consumer is what drives the business cycle, and they are struggling. And they are struggling with the high payments rates, interest payments, and that is hurting in consumption, and that will eventually then flow into the businesses that will start to lay off jobs. That we do not see it yet is not the same as saying it will not happen. And I think this is exactly what we see every time before a recession. We see the same thing. We have the people saying, oh, now we have a soft landing. Go back and before the financial crisis, you'll see exactly those words just in 2007 and even in 2008. And then you look at it and you say, where is the soft landing? Because interest payments are still high, interest rates are still high. The interest payments are so high for the consumer. So why is it really that you think that it's so good? And as I said, also you start to see it now in the credit card delinquencies. You start to see it in other loan types, the car loans also, where you also start to see delinquencies coming up, like strongly up. So I think people are do not really look under the hood when they check it out. So Titanic has hit the iceberg, and unfortunately, there's not much to be done about it at this point.
So before I ask you about some of the comments you just made, I got to bring up the fact that I haven't thought about that show, The Roadrunner, for many, many decades. Used to watch that when I was a kid. I used to hate that show because he could never catch the Roadrunner. And they never used to talk either. That also drove me crazy. So
All right.
I want to ask you about the yield curve, okay? And in the past, this inverted yield curve has been a great predictor of recessions, but it's been inverted now for over 660 days, the longest streak ever. It actually took out a previous record that has been in place since
3 months ago, I think, even.
Yeah.
Yeah.
So do you think this indicator is still reliable? Does it matter anymore?
Absolutely. Absolutely. And this is where this time is not different. This time is just bigger. And the reason why this time is bigger is because we have a massive distortion of investment, of money. So when you've been throwing money on everything over the last 16 years, and every time you've had a problem, let's throw money at it. Well, then you start to get distortion in the markets, which means that investors are seeking yields. So when you look to private equity companies, they have been, the partners, they have been, desperately searching for places to go with their money and say, well, what can we do? Where can we invest? Give me some, crazy ideas. And then they go and they put their money in all of the sorts of, businesses, and they have been keep pouring money into that. If you look to the whole crypto market, I'm massively bullish the crypto right now, and I hold a lot of crypto. Mostly of my investment, my portfolio is in crypto related assets. So I'm not saying it's right now, but I'm saying that is a distortion of money. That's speculation. When people start to sit and talk about Solana versus Ethereum versus something else, that is speculation. So, and it's all yielding zero. It's all yielding zero. So that is the very definition of the bubble. And I when the shit hits the fan, so to speak, when we're starting to see the recession coming out for real, then people say, yeah, but the Fed, they will just print again. So they will save the day. Well, what if that free lunch is not available anymore? It's not possible to do so. Because if you do that, you can trigger inflation again. And that is what I'm starting to see, that you have a situation where inflation will be coming down, but if they do it, you as a person, in order for letting the money printing help you, you need to take on that extra loan to go buy that car. You need to spend extra money. But you've been hurt so bad by the inflation and by the high interest rates. So you're saying, you know what? Maybe that extra check that is coming in, or the money that I save on my house loan because the interest rates are coming have declined or fallen. Why do we not save that a little? And let's see how times are playing out. And if that happens, if that psychological effect is happening, then you do not get the trickle down effect that quantitative easing or the monetary stimulus is based on. And then you have another problem because then you do not see the bounce in the market. Then you may see the money starts to chase investments or chase things. So you can see crazy moves in the in certain assets, but it will not help the real market, which is the labor market and the housing market necessarily. So I think we have a situation in front of us where we will see a very bad deflationary period caused by a recession that sets in by Q4 this year.
So I recently saw an interview with Jeffrey Gundlach of Double Line, and he was saying something very similar. He was also surprised we haven't seen a recession yet, and he thinks it has to do with this excess of money printing that we've seen here in the last few years. I believe he said prior to the pandemic, there was $4 trillion in circulation, and now it's around 20 trillion. So these massive distortions have just, I guess, thrown everything out of line, right? So it's very hard to predict where things are going.
Yeah.
Thoughts on that?
I agree with that. Absolutely. I agree with that perspective.
So let's talk about the Fed now. And I know the last time we spoke, you told me you don't care about the Fed and what the Fed's doing, but I want to discuss it because of the policy errors that the Fed has made. And it's because of these errors that we find ourselves in this mess that we're currently in.
Yeah.
And the first one was when they said inflation was transitory in 2021. And then by 2022, they realized, oh my God, we got a serious problem here. So they started lifting interest rates at the fastest rate we've ever seen in the history of the US. But do you think they're making another policy error here, that maybe the economy is a lot stronger than we think it is? Maybe inflation is not going to come down to that 2% target level, and it's going to heat up again. And therefore, they're not going to cut interest rates, but they're going to maybe increase interest rates come 2025. Is that a risk?
I don't know what the Fed will do. I mean, this is where, but I don't see that happening. I mean, there are so many indications that we are already now that the monetary policy right now is rather strict, even though the financial conditions are easing. But if they look at the real economy and they look at the housing market, they look at the consumers again, well, if they do that, then they will for sure strangle the child, so to speak. They will strangle anything that needs to be that needs to grow. I mean, that would be a policy mistake, and I think right now actually that they are being also too hawkish, let's say. If they look into again the consumers and the way they struggle, again, they are right now putting into the minds of the consumer the future, behavioral patterns that the consumer is going to follow, because they will be so, more and more scared of actually spending the money that, eventually become more loose when the monetary policy starts to become, more eased again when the business cycle turns over. So I think we're seeing that they are, making a mistake, but they will follow the market yields when they start to drop, and the market yields will follow when they're down, when we start to see the coincident indicators, which is the labor market starting to decline. So we saw the initial claims last week. We saw that they were a little higher than expected. Now this week they were down again. So we need to see that slowdown, but as I see it, it's coming. And again, I'm willing. People are saying, yeah, but you said that was, in mid of 24, and now it's late. And I say, yeah, but the thing is, sometimes things take a little longer. The point is, the market yield inversion is something that we can use to time the recession on. And normally we see 12 to 15 months from the bottom of the market yield inversion. That means as it's mostly inverted, to the onset of the recession. That yield inversion, that was 12 to 15 months. That yield inversion was at the peak in June of last year, and now we are in May this year. So we still got a couple of months before, in a normal cycle, we should see the recession. So we are like 11 months in. I'm saying 12 to 15, so 4 or 5 months, and it could be even more because it's been massively inverted this time. So the Fed will, of course, try to react, and they've done that before. They will try to react to this. I think they're making a mistake of being as hawkish as they are now, because they got too scared of the genie coming out of the bottle. But the thing is, with the recessionary impulse that I see is coming, you actually need to start, soften that blow already now, or they will try to chase it, and then it'll be too late. So I think they're being too restrictive right now, too hawkish right now.
Yeah, you mentioned about the U.S. consumer and how well they're doing or not well they're doing, and I thought it was interesting when we saw numbers out of Starbucks here a few weeks ago, and they missed their numbers significantly.
Okay.
Same store sales in the US were down 3%. In China, they were down 11%. Those two markets represent 60% of total revenues. But I know it's just one data point, but you got to wonder, if somebody's not willing to spend $7 on a Frappuccino, what else is happening, right? Like, they really might be starting to feel some pain, and it's going to be interesting to see what happens here in the coming months and how active they are just in terms of travel.
Yeah, absolutely. And also, if you look at the excess savings that you had, that the consumers had after the corona, and you saw also the the credit card delinquencies that I talked about earlier. If you start to look at that, you will actually see that it's, of course, the weaker part of the consumers is the young people, and the ones that do not have as much, that will start where we'll start to see this coming to, and that is, we're actually seeing that right now. I mean, there are the similarities to the kind of move that we saw in before 2008, or the onset in 2007 in December of the recession there, is similar to what we see now. So yes, it's not about pointing out a specific time, the date, this year, saying this is when the recession will set in. It's about looking at the pattern and say, are we actually seeing a soft landing, as the Fed is saying, or are we seeing that the consumers cannot afford another cappuccino or frappuccino or whatever? And I think we're seeing exactly that. That is the weaker part of the consumer chain that we are seeing maybe getting hurt first, and it's hurting everybody. I can tell you, it's so easy to say that a lot of people that I know, but obviously a lot of people here in Denmark as well, and in Europe, you can see that they are also, struggling with the high interest rates that we have. So ordinary people are hurt by this, and this is bringing consumption down, which is hurting the economy.
Yeah. I am based in Toronto, and I'll tell you, I'm feeling pain, and I know so many people are. And another interesting point about Toronto and Canada is that when it comes to the housing market, we can only get a 3-year or 5-year mortgage. And so a lot of people are going to be renewing or refinancing their mortgage here in the coming months. And I recently had a conversation with David Rosenberg, and he thinks we're going to see a major reset in the Canadian housing market because of these mortgage payments going up significantly.
Yeah, and here we have the same. Like, we have 1 year or 2 years or 3 years and 5 years. You can do it differently. but the shortest one have been refinanced a few times. But and I have like that because I think the rates are going to come down. So that's why, when you have a mortgage, you probably, finance like that. And then and you can see that they are, they have been stubbornly high. Will they come down? Yes, they will start to decline, but it's for now, it's just hurting the people who hold these and needs to refinance and get in and get a new loan.
So let's go through some of your target prices, okay? And now I want to begin with the S&P. It's currently trading around 5,300. Your target is 6,100. Is that still the case?
61 to 62, yeah.
And can you put a timeline on that?
So my timeline for now is that I see that the recession probably sets in by Q4 this year. Could be October, November, December. And I think the stock market will top out 2 months before that. So that means Q3, potentially October. So, but right now it's August, September. That is my potentially September as the timeline for that. That is the best. I would not call guess, but best estimation based on what I see. There is nothing that tells me that we should go above this. We have on various assets, we start to see weaknesses come in. We start to see weakness in Europe. We start to see weakness in Asia, in the Nikkei, in the Nifty as well. So I think you're going to see the top in the stock market in Asia and Europe setting in before you see in the US, and you're going to see a rotation of capital from Europe, from Asia into the US. So that's why I'm saying I'm not bullish across all markets. I'm bullish the US market at this point. I'm bullish small caps because I also think there will be a rotation from large caps into small caps as we get into the final phase of this business cycle.
So still bullish on the S&P and the NASDAQ in the short term or going into September, October. Now, what about Bitcoin? It's currently trading somewhere around 65 to 70,000. It's up about 60% on the year. What's your take on Bitcoin?
Well, I still hold the same. I think it was the same in January. Also, I said 110 to 115,000 on Bitcoin, and I stick to that. I think we're hours or days away from a big move starting again. We had a big move on Monday. I think that was just the beginning. Now we've been consolidating for a few days, and I think we're going to see a very, very big move coming into mid-June. But an uptrend with consolidations or pullbacks into again the same timeline as with the stock market. So again, August to October, I would say this is the timeline now. It's more about the levels that I need to see. I need to see above 105,000 for Bitcoin, 110,000, and then I need to see the S&P around 6,000. Then I will start to become more worried. These are the levels timeline-wise, Q3.
And it's interesting to see Bitcoin. It's had a massive move this year, even after a big move last year. I think it was up 160%, but it's receiving a lot of legitimacy here with the SEC approving the ETFs. The SEC just approved an ETF for Ethereum. So that's going to create a lot of interest in this space. And my sense is not that I'm an expert on Bitcoin, but it looks like it's been consolidating after this whole halving process, and it could be getting ready to go again. So once again, bullish on S&P, bullish on the NASDAQ, bullish on the Bitcoin. Let's talk about gold now. I'm a big believer in gold. I always have 5 to 10% of my portfolio allocated toward gold. The last time we spoke, it was around $2,000 an ounce. Now it's around $2,400 an ounce. It's up 12% on the year. What's your take on gold here in the coming months? Hi, I hope you're enjoying the interview. One way I use to protect my portfolio against the constant erosion of inflation is with physical gold. And if you would like to learn more about the benefits of owning gold and how to buy it and how to store it, visit hardassets.alliance.com. Hard Assets Alliance is a trusted platform with over $3 billion in assets, and it's used by over 100,000 institutional and retail clients. They offer American Eagles, Canadian Maples, South African Krugerrands, and also gold bars. Once again, that's hardassets.alliance.com. There's a link below in the show notes. Now back to the interview.
My take is that I think gold is the outlier. If you look at the rest of the precious metals, if you look at palladium, you look at platinum, you look at silver, they are all lagging, tremendously gold, or gold is trying to lead. I think what you're seeing is that everybody speaks of gold and says, "Oh, gold is, this is where you need to be." But if you're going into the kind of recession that I'm looking at, which will also be a banking crisis and a liquidity crisis, you do not want to hold gold, because the finest job for gold is to provide liquidity in the hour when you need liquidity. That is why people are so, hold gold into a crisis. It's not because it's something that you want to invest in, because it's not an investment. Why hold something which yields zero? You want to invest in it the moment the Fed gets in. That I agree on. But if you have a 6 to 9 months of decline in the market, or strong decline like what we had in 2008 from March to September, or March to October, you had gold drop like 34%, silver drop 60%. And that's because you don't want to hold that, because you need your liquidity. You need liquidity to pay off debt. This is the kind of scenario that I'm envisioning here, and I don't think gold is leading here. I think gold has been overbought by a lot of people on the belief that this is what is happening, and now we're going to see inflation. But I think when the opposite actually shows up, and you can start to see people also selling off golds to pawn shops and the likes, because the consumer is struggling, they need liquidity, they need US dollars. So even though I'm bearish the dollar right now, I think gold will not do well into the next coming weeks and months. But I can still say we could meet in a couple of months' time, and could we then have seen gold a little higher than now? Yes. But is it something that I would invest into now because of the narrative that gold is leading gold, silver, and the rest? No, because normally actually you need to see miners, silver, platinum, and palladium also following what gold is doing, and they do not. Actually, the miners are down a lot, and you start to see also that they could also put in the top at this point here. So I think gold has been overbought. And yes, I've been bearish for some time. I still say that it could have a very large drop, and I would not think it would be unrealistic to think that it drops like what it did into the financial crisis, and maybe even more than that. So I still stick to around the 1250.
Yes, and gold is interesting in here, I will have to say. I mean, it's well documented. Central banks have been large buyers in the last couple of years. I believe in 2022 and also 23, they bought approximately 25% of all production. So it's obvious that central banks are out there buying it and bidding it higher. And I guess the other thing too is, especially after the invasion of Ukraine, of course, the U.S. Confiscated a lot of Russian assets. So a lot of other countries are saying, okay, what happens if, they do that to us? What are we going to do? So there's speculation the central banks are buying it for this reason, and China is one of those central bank buyers, huge buyers. So
Yeah.
I guess the other point I would also make is, even though gold's trading at $2,400 an ounce, the stocks are not reflecting that price. And
Yeah.
I haven't seen any.
Absolutely not.
I haven't seen any research recently as to what price they're discounting, but there's no way it's $2,400. I'd be surprised if it was even 2,000.
Yeah, but I agree with that. I completely agree with that, and that's why I think it's been overbought on all this, with the speculation on this. And again, would I hold, if I had cash of money here, and I'll say, okay, do I want to invest that in gold, or do I want to invest it in something that I think is in an uptrend here that moves faster? I would rather put it into the Nasdaq right now, or into small caps, or into Bitcoin, or even to crypto at this point. So, and then if I'm right also that we're going to see a strong dollar into a recession and a liquidity crisis, would I hold gold then? No, I would not. But would I hold it the moment the Fed steps back in and say, okay, now things are, and we're, far away from that yet. I mean, that's way into 25. Yes, absolutely. That's the bottom in gold. That's when I want to hold it, because that's when the new phase starts. But I think people are maybe trying to front run something here, which could take some time before it unfolds, and actually you could see a decline first. But I'm getting ready for that also. The moment I have a gold a list of gold miners that I want to buy into, but they just haven't seen the right levels yet, and I think gold needs to come down first.
So let's also talk about oil. Oil, I have to admit, I'm quite surprised oil isn't higher. It's currently trading somewhere 75 to 80 bucks a barrel, WTI. And I think there's a lot of manipulation going on within the markets. Of course, the Biden administration wants to keep the oil price lower as he goes into an election. And then you got the Saudis, they want the oil price higher. The Russians want the oil price higher. So who really knows what's going on there? But what's your take on oil?
Well, from a market perspective, you could say that if you have an economy that is slowing, then oil is the very indicator of that. So if everything was accelerating here and also inflation was to accelerate, you would see oil being up a lot more. But but I don't see that. I mean we have, you were talking about the GDP numbers and saying, yeah, but actually they have been declining for some time. And if you the only thing that were up really now is the PMI numbers. They're like, oh wow, fantastic, things are good and great. um, I think that the truth is something is something else, and that is that we're seeing a slow deterioration of the economy. That means that people will drive less miles. That means that less oil will be needed, and that's why we see the downward demand pressure. So demand is coming down. You can see that also in China. It's actually rather obvious there that you have a demand decline there. So that means that oil price has to come down. And that is what we see, I think. But obviously there can be some also political reasons for it. But I think that is the main driver of it. That's really because of the slowdown of the economy. And that's not something that happened. We have to think of the economy as a super tanker. It really does not turn like a speedboat. And I think that is where a lot of analysts and medias and so on think, oh, we saw this and now we see this, and so they jump to conclusions. What you need to see is it's a slow turning, boat, ship that and it takes a long time, and sometimes it takes longer depending on how big the distortions are and all that. But the trend for oil is down, and I still think you're going to see a very large decline again. I still hold the gold will go below $20, maybe all the way down to $10 again into a recession.
Well, that would be a significant pullback. So I always enjoy asking people what the price of gas is wherever they're located. What is the price of gas in Copenhagen? How much are you paying a liter?
Oh man, I don't even know. I don't have a car these days. So I don't. I drive. Yeah, we have the metro system here, and we have the bike also, as you said. I don't use the car because it's such a small and city where the infrastructure is so great. So I don't know. But it's I can remember it was a couple of dollars or something like that. So now a little more than $2.50 I would think. So something like that.
Oh, that's high.
You
So
caught me there.
I'm in Toronto and I'm paying $1.60 a liter, which is probably close to $6 a gallon.
Yeah.
So I thought we were paying high prices, but I guess it's significantly higher in Denmark.
Yeah, that's $2.50 for just a liter. Yeah,
Yeah.
correct. So I don't know,
But
we pay a lot more here.
it's always amazing how the gas price is different regardless. Like even in the state of Michigan, which is right beside the province of Ontario, they're paying $3 a gallon. Okay, so it's like 50% cheaper than what we're paying here in Ontario.
Yeah. Yeah. No, but that means a lot, and that's for the consumer, it's very important where the gas prices are.
Okay, so I want to look at a possible catalyst for what's going to take this market lower. And I know you were talking about the debt level, so I want to have a deeper discussion there. And in 2000, the US had a budget surplus of $123 billion. Now in 2024, the US has a deficit of 1.7 trillion. Also in the year 2000, the national debt was $5 trillion. Now it's $35 trillion, and it's increasing by 1 trillion every 100 days, if you can believe that. And of course, we have billions of dollars that will be coming due here in the coming months and years, which the federal government will have to refinance at significantly higher interest rates. And that debt, which is currently 25, 50 basis points, is going to be significantly higher at 3 or 4%. But do you think this could be another possible scenario that will really take the market lower, that a realization that these debt levels can't be sustained and the interest payments associated with these debt levels can't be sustained?
See, that would happen in a world where the interest rates were going up. So if I was in a situation where we're starting to see inflation coming up again and interest rates coming up, I would think that would happen. So if you're talking about the next year and a half, 2 years, I don't think this is going to be the trigger of the crisis. I'm going to think that the trigger of the crisis this time around will be the consumers again, as I spoke of. But if you look at the debt, obviously, then something is going to has to change, because we cannot see that this is unsustainable, obviously. So I think if I'm right, and now this becomes a little more, speculative, probably what people will say, but I think you're going to see a crisis now where the recession will come in as a normal part of the business cycle. The consumer, hurting, and then start to spend, and all of a sudden we get these negative GDP numbers. The Fed will then observe it for a little while and then say, okay, now we need to jump in. They will jump in and they will do what they do. They've done many times, is that they will print money, or they will do QE, and they'll do their magic. And then they will get a bounce in the market. But I think, as I said, I think there is a change, a fundamental shift, which will make the consumer not starting to spend, or not trying to take out that extra loan, or whatever it will be. So there will be more resilience in taking on more debt, and also spending money, which will mean that the economy will suffer for longer. And in that world, I could see that money comes in, will start to circulate faster, and I could see that we could see a speculative environment develop, where you see that the inflation could start to move up. That could be a stagflationary world, and that's also why I would hold gold at that point. I think we could see stagflation coming out as a second phase of this crisis. So now you are a year and a half, 2 years down the road. I think that's the moment when we could start. We would see that there could be some problems with debt, because obviously if you start to see stagflation, interest rates will come up, and you will see also that the deficits will become much bigger, not just in the U.S. but around the world, and that is where you cannot just pour money at it any longer, and that will be the real eye opener for a lot of people, that you cannot save any decline just by pouring money on it. So at that point, I think we're going to have to deal with the debt levels, and that will probably be along the lines of some sort of monetary reset, or whatever it's going to be. They're going to do something on a bigger scale that I'm not too clever enough to understand or to do, but I think they were going to do something that will along the lines of what the Bretton Woods back in 1944. Also, this could align with the whole geopolitical situation with the BRICS and all that. I could easily see that we could get into a new kind of where they will say we are actually going to go after black money that has been earned through crimes, or black money, or whatever, and then they will actually, what they do is that they will try to restructure the whole thing. So because obviously the path we see right now is unsustainable, and it's just we just need the trigger for it. I don't think it will not be the trigger itself. At least it will not be seen like that. But there's something will need to be done about this development.
What are your thoughts on central bank digital currencies?
Well, I think it's something that they all considering. I think it's something that by the end of the monetary reset that I talked about here is something where that will be part of the solution. I think that the only way that you can recreate credibility to the financial, not to the monetary system, to money by that time, especially if you have a stagflation, will be to create more transparency. And now I know that a lot of DeFi crypto people will not like what I'm saying, but I think actually the whole transparency part of the crypto will be what is driving the central bank digital currency setup. And I think they will outperform, and they will do not want to have any competition to that. So I think a lot of cryptos at that point, if they were not already crashed by stagflation and deflation, well, when that comes out, I think we're going to have a cleanup in the crypto land. So I think it's something that is going to come. It's going to come as part of the restructuring and of the monetary reset. And I know that the ECB is already working along these lines. So it's coming. It's coming.
Governments always want total control.
One more time, sorry.
Governments always want total control.
Yeah, absolutely. Yeah, 100%. And especially if things are getting out of control, then they will do everything to get it back to control.
So let's summarize everything you have mentioned. And I want to make sure I got this correct. Okay. So we've had massive amounts of money printing, and the money supply has doubled in the last 4 years, and this has resulted in inflation that we haven't seen in 40 years. The Fed is trying to fight this inflation with the sharpest increase in interest rates in the history of the financial markets. They've gone up 11 times over 16 months. And with this explosion in interest rates, it's caused a lot of shocks throughout the system, or it will create a lot of shocks throughout the financial systems with both corporations and also personal spending and personal wealth. And you think this slowdown that we're going to see from corporations and also from the consumer, that this is going to cause the Fed to act quickly, and they're going to have to start slashing interest rates to stimulate the economy again. But by the time they start doing that, you think it's going to be too late, too little, too late. And
It's always too late. They always come. They always say that they are, ready for it, but it's too late. And I think, as I said, also, I think they should be looking into it already now if they wanted more of a soft landing.
And just to go through your target prices again, so the S&P is currently trading around 5,300. You think it's going to go up to 6,100 by sometime in Q3. Bitcoin currently trading around 70,000. You think that could hit as high as 115,000 by the same sort of time period. Gold, you're negative on gold, even though it's trading around 2,400. It might get up to 2,700, but ultimately you see it going significantly lower down to 1,200. And oil, once again, you're also negative there. It's currently trading around $80 a barrel. You see that also collapsing, maybe down to $20 a barrel. Do I have all of that right?
Yeah, and again, we have to remember that it's never a straight line. So when I say gold down to that, obviously you can see bounces and all that. But I'll say, yeah, in the bigger terms, I could see gold will both gold and oil will decline into a recessionary outcome. Yeah.
So having said all that, what are you suggesting to investors? How do they prepare for all of this? So right now, of course, in the next 4 or 5, 6 months, you want to stay long and you want to capitalize on this big move in both the S&P and the NASDAQ and Bitcoin if you play cryptos. But what about after that? What are you suggesting investors do?
Well, even though we talked about debt, I think bonds will be a fantastic place to hide out in the deflationary part because the interest rates will come down, and I think we'll see fantastic moves in TLT. I think dollar being long dollar versus against any pair around the world. I prefer against the euro because I think the euro will have structural problems. So I think that that pair could see a again, we're not talking right now, we're talking later because right now I think actually the euro will actually strengthen against the dollar for some time into August or September. But after that, I will be holding dollars against against any currency and maybe even do some trading there on that. And yeah, and that will be what I would do into the to recession and the market decline, because there may be people that want to short the market, but I think the market volatility there would be a lot of volatility, and then you need to be able to stomach that. And I think a more easy ride will be best for me there. When the Fed gets back in, I think that's the time for gold miners and the likes, and we are we just need to see that the onset of the recession first.
Well, Henrik, that was a fascinating discussion. And as we wrap up, if someone would like to follow you or learn more about the various services that you offer, where can they go?
So I think that we should go to my Twitter account at Henrik Zeberg, and they can find a lot of also links there to various websites and also the Zeberg report, and to also Swissblock, where also I'm head of macro, and so there will be many opportunities to find me, on different pages.
Well, Henrik, once again, that was a great discussion. I want to thank you very much for spending time with us today.
Thank you very much for having me on.